Let's talk markets now with Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Cameron, good to see you this morning. We've kept up a bit in terms of your market view here, and I know you've been kind of keeping stocks on a little bit of a short leash, allowing for the possibility of another rally, but maybe we're getting to the extent of where it's going to have to tell us whether it's more than just one of these kind of reflex rebounds that we've had over the past year. What's your current read on that?
Yeah, certainly we have seen this rally in the beginning of the year just driven by the fact that positioning got so light at the end of 2022 and expectations got so low, which really set us up for the pain trade simply to be higher. And the technicals have improved. Mike, you've been talking a lot about how we've been breaking above that 200-day moving average in key indices. The question is that under the surface, we haven't seen the big surge in momentum from a technical basis that we typically see at the start of a big bull market. So on the short term, we're heading into Fed week, which really creates a big wild card for markets. And then as we look in the medium term, we do still continue to see those headwinds from a valuation and an earnings perspective. But of course, those take time to play out.
For sure. I mean, I guess there's another way of maybe applying a little bit of a narrative to what we are seeing in the last several months. And this would be certainly the optimistic take, which is, look, the stock market went down 25% from high to low at a time when profits were still looking pretty good. The economy obviously was in good shape, and the Fed was tightening along the way, and the economy kind of absorbed it. Now we're at a spot where, well, the Fed's probably almost done. The economy hasn't fallen apart yet. Earnings not great, but maybe we priced a lot of that in. So where would you take exception?
Yeah, I think the hard part here is valuation, because as of Friday, we were trading at about 18.2 times forward earnings on the S&P 500. And that 18.2 times is very close to the prior peaks in valuation pre-pandemic. So we peaked around 18.5 and 19 times in early 2018 and early 2020. So in order for this market to move much higher from here, looking like 15% upside for the full year, you essentially have to assume that we go back up into pandemic era bubble valuations, 20, 21 times plus. But the only reason we were able to trade to those valuations is simply because we were flooding markets with liquidity. So we see a challenge that even if the Fed pauses from here, that's not the equivalent of growing money supply by 20% or balance sheet expansion. And so we think that valuation still is essentially the ceiling that acts on this rally.
Certainly from an index perspective, it's tough to get around that math. Absolutely. I would assume, and if you take away kind of the top 6 stocks in the S&P that trade at 20-something times earnings, there are pockets of this market that might be better positioned. Are there any that you're more focused on now?
Yeah, I think that's a really good point, which is that if you look at the equal weight S&P 500, it's still trading at slightly below average valuations, which is one of the reasons why we think that equal weight was better than market cap weighted if we were looking for some kind of index to buy into. But then from a sector perspective, we do see attractiveness within energy from a valuation perspective. It's still trading at just 9 times earnings, which is essentially the market saying, we don't believe that this strong profitability can continue. And then we've been looking at some of the cyclical sectors that do have lower valuations, like financials and materials, that were left through debt for dead through the past cycle.
All right. Looking below the surface of the index. Cameron, great to see you. Talk to you soon.